The US banking industry just got shaken by a flash crash of some publicly traded stocks in a crisis reminiscent of 2023 and 2008. Now, out of nowhere, two banks saw their share prices crater, press releases launch out into the media, and an entire cover-up operation launched to try and hide this crisis as much as possible and restore faith and trust back into the banking system. The problem is that there are inherent hidden systemic risks threatening to drag the entire US banking industry underwater the second the market finally realizes what's going on. And there's a 99% chance that you actually have no idea that this is even in the case. And in this video, I'm going to tell you and explain exactly what just happened, why it happened, what the systemic risk is here, and how to protect yourself so you don't lose money when there's a run on the banks and everything falls apart. Because the US isn't alone in being screwed here with this banking crisis. The UK, Canada, Europe, the list goes on. Banking crises cause contagion around the entire world, and the cost of even this very little flash crash was in the hundreds of billions of dollars, reaching every single country on every single continent. So if you want to escape this doom loop to protect yourself and your family from a credit freeze or another great recession and build an online income with zero experience ever doing anything like this before, well, I'm going to be running a free class showing you exactly how to do that, how to build an online income up to $3,000 a month from scratch with no experience. There's only 100 spaces available for the free class. It's done on a first come, first served basis, and you can see when it is and register and save your spot just by clicking the link down below in the description. Now, on Thursday, two major regional banks in the US saw their shares drop almost out of nowhere after they released reports saying that they were the victims of fraud on loans to funds that invest in distressed commercial mortgages. Now, the press releases that they released looked something like this. This is from one of those banks called Zions Bancorp, and the other one was Western Alliance Bancorp as well. Now, what this statement here says is basically Zion was forced to write off a $50 million loan that it gave out under a subsidiary based on commercial mortgages. They did this because they learned new information which led them to believe the borrowers committed fraud, and now they expect to lose almost all of the money they lent out. They lent out $60 million, they have been forced to write off $50 million as a loss. Western Alliance Bancorp then came out and said that it had lent money to the exact same borrowers and was also expected to take a loss. So what exactly went wrong here and where was the fraud? Well, as you can read here, California Bank and Trust provided two revolving credit facilities to the borrowers in 2016 and 2017, totaling more than $60 million to finance their purchase of distressed commercial mortgage loans, according to the lawsuit. The terms gave the bank first priority perfected security interest in all collateral, including each mortgage loan purchased by the investment funds. But after an investigation, the lender found that many of the notes and underlying properties were transferred to other entities and that those properties have already been foreclosed on or were about to be, according to the lawsuit. So $60 million was borrowed years ago to buy up distressed commercial mortgage loans and property. The bank that lent this out, they were supposed to have priority in repayment so that even if everything goes wrong and the borrowers go bust, well, the bank still gets their money and they're still made whole. But it turns out that the loans and the underlying property had been sold off to other entities, basically leaving the bank high and dry with nothing to collect on, and so Zion has been forced to write off almost their entire loan as a loss, and Western Alliance came out and said that they were basically in the same situation, but we don't know how much they've lost yet. Now, this news itself shouldn't really be able to shake markets all around the world, right? This is a $50 million loss on a loan for a mid-sized bank that's worth about $7 billion right now. That's Zion, and Western Alliance was worth about $8 billion as well. So a $50 million loss shouldn't really be enough to hurt these banks beyond just 1 or 2 quarters of slightly lower earnings, and it certainly shouldn't, on the surface at least, be causing massive crashes of £13 billion lost in UK lenders over just these two relatively small American banks reporting a bad week. Let's be frank, even if Zion and Western Alliance both went entirely bankrupt and literally disappeared, they alone simply aren't big enough to impact the American economy as a whole, let alone the rest of the world. So why did the UK's markets move on this and the S&P 500 as a whole, and why were so many banking stocks all around the world seeing their share prices crater on this news? Well, because this didn't happen in isolation, and there have now been a load of other examples of very serious problems within the financial system in recent months, and when looking at all of this in aggregate, well, actually it is a little bit worrying and there are some major problems emerging here. Now, the first thing to mention is a company called Tricolor Holdings, which was a US-based car dealership and subprime auto loan lender. They gave out loans to people with bad credit, second-hand vehicles, and in particular, they'd been caught giving out loans to a lot of illegal immigrants as well, and people who didn't even speak English in the US. And it's believed that there was a load of fraud going on with those loans. Now, Tricolor were also in the business of packaging up those loans into bigger securities called asset-backed securities, much like the collateralized debt obligations or CDOs of the housing collapse 20 years ago, except they've been smart enough to change the name from CDOs to ABSs this time around for the sake of optics. But regardless, last month they filed for Chapter 7 bankruptcy after literally running out of money, but it seems there might be some fraud going on there too. There are claims that Tricolor had been pledging the same assets to multiple different ABSs so they could sell more of them, meaning that they aren't really asset-backed securities. And then there's also accusations that there were mistakes or irregularities in their financial filings and data. But all in all, losses for this here could be as high as $5 billion. And those losses will be borne mostly by the banks, which owned these securities which were created and sold by Tricolor Holdings. As an example, Fifth Third Bank said that it expects to lose about $200 million from this, and JP Morgan reported another $200 million in expected losses as Tricolor Holdings went bankrupt, and there will no doubt be countless more banks who have lost millions on this as well. Now, all of this happened about a month ago, so still not 100% clear what actually happened or how much will be lost in the end. But again, this didn't happen in isolation, because then there's also something called First Brands Group. And again, they were in the auto industry. They were an American auto parts supplier based in the US, selling everything from wiper blades to brakes and spark plugs. And they were actually not publicly traded, but had expanded loads in recent years by buying up competitors very aggressively using a hell of a lot of debt. Now, the problem is that there were a load of pressures on the fundamentals of the business. There were high interest rates, which meant that their debt obligations were huge. There were tariffs on imported car parts, which presented a challenge for the company. And then, of course, it turns out, again, there were irregularities with the company's reporting and their financing. They were using these weird invoicing methods to hide liabilities and to keep them off the company's balance sheet and off their books. And in the end, about $2.3 billion in liabilities were hidden overall. They tried to refinance about $6 billion worth of the company's debt. Yes, I did say they have a lot of debt for a private company, but after lenders took a look at the actual data, they realized something was wrong. The company gets accused of fraud, assets get frozen, and the company just falls apart almost instantly. Now again, this is a pretty new event, so we don't know the exact amount which we should expect to see in losses here, but liabilities have been reported to the SEC at between $10 and $50 billion, so very large, whereas assets are between just $1 and $10 billion, so definitely not enough to pick up the slack. In my opinion, the total losses here are likely going to be in the $10 billion range, and we've already had a few examples pop up. The Point Bonita Fund revealed that its exposure is $715 million, UBS over in Switzerland thinks that they might lose as much as $500 million, and a Japanese company who sold to First Brands has $1.75 billion in exposure. Raystone, a lender, they have $2.3 billion in exposure. Basically, yes, we're almost certainly looking at more than $10 billion in losses here on the low end. And again, this has only recently been a crisis for the last month or so, and because the company is private, there's much less information available publicly about their assets or their liabilities, so we aren't going to know the full picture for a while here. Now, with these collapses, we are talking many billions in losses, and JP Morgan's CEO Jamie Dimon is out there sounding the alarm, saying explicitly, when you see one cockroach, there are probably more, and so everybody should be forewarned of this one. Basically, these aren't the only companies which are going to collapse from this. There will be more to come, as evidenced by these two banks having this shock based on fraud on some of their loans. Now, this can be worrying. The global financial crisis, the Great Recession, the housing market collapse, all of that started off with very similar circumstances as we're seeing here today. Subprime auto loans and subprime mortgages being packaged up into securities, their true risk hidden on purpose, and then sold on to over-leveraged banks so that they could make huge profits. And in a moment, I'm going to explain where this is likely going to go in the future as well. But before that, I do just want to make a quick point that we aren't just talking about the United States here. This little banking crisis caused stock markets to drop around the entire world. Huge banks like UBS out of Switzerland and Deutsche Bank out of Germany were losing tens of billions of dollars in market valuation, all because of two relatively small regional banks in the US booking $50 million in losses. Now, the reason for this is because the entire global financial system is ridiculously under-collateralized that even the slightest little problem can bring the entire house of cards down, which means that you are at risk if you're in the US or Canada or across an ocean away like me in the EU or UK or Australia. And even Chinese and Asian banking stocks crashed on this news, showing just how insane a crisis like this could really end up. And I think it's so important that we're able to recognize that and protect ourselves against what's coming because it's going to be bad. And I want to help you prepare for these problems. So I've put together and I'm going to be running a full free class teaching you how to build a $3,000 a month online side hustle from scratch today. It is 100% free and I've spent the last month putting this class together and spending literally dozens of hours on it. And in it, I'll show absolutely everyone how they can use this new system that my team and I have built to build an online income up to $3,000 a month guaranteed. Now, there are limited spaces available for this free class. There's only 100, and the last time we ran one of these spaces filled out on the first day we announced it. So click the link down below in the description to save your space and to see what time the free class is actually happening on your time zone. Again, it's free. I'll show you everything you need to build an online passive income without needing any prior experience so that you can protect yourself from a crisis like this, and we'll even have some fun on the free class as we do it as well. So click the link down below in the description to save your space. Now back to the video, and one of the biggest problems about this here is that actually these problems aren't new. Many of us will remember 2023 when we had a little run on regional US banks and a bunch of them collapsed, the most infamous one of course being Silicon Valley Bank. Now, for anyone who doesn't remember, SVB was basically the most popular bank for tech startups in San Francisco for years, and as it collapsed, it went on to evolve and create the 2023 US banking crisis. Now, SVB was worth about $15 billion with assets under management of about $200 billion, and they took loads of those assets. They invested into US treasuries and mortgage-backed securities. Again, going back to these real estate commoditized financial instruments causing the fundamental problems here, just like we saw back in 2008. Now, these assets are considered safe, but only if they're held to maturity. Now, when the Fed raised interest rates in 2022 to fight inflation, that started to create problems with those assets. Their yields rose, but the market values of those assets dropped off a cliff, and SVB ended up with unrealized losses well into the billions on their books. Now, for months, SVB was able to just ignore these unrealized losses because they were unrealized. And if SVB were able to hold those securities until they matured, then the losses would just disappear. But SVB, unfortunately, was irresponsible with their money. Their clients were mostly venture capital-backed startups who spent huge amounts of money. But what happened in the wake of COVID? Well, VC funding had started to dry up, especially as interest rates rose. So SVB found itself in the middle of a run on the bank. They were then forced to sell some of their securities just to have enough cash to pay out their depositors who were trying to take their money out to run their businesses, and in the process, SVB had to book and concrete down on their books $1.8 billion of losses on that trade. Now, they tried to reassure their investors by saying that they were going to raise more capital, but that just spooked the investors and the market turned against them. It turned into a full-on bank run, and everyone with money in an SVB account, they rushed to take it out, and SVB entirely ran out of cash and the bank just collapsed. Then basically the exact same thing happened to a bunch of other banks as well. Silvergate Bank, Signature Bank, First Republic Bank, all these regional banks worth billions of dollars and controlling hundreds and hundreds of billions of dollars in assets under management, they collapsed with a run on them destroying their liquidity. Now, one of the big issues with these bank collapses was that the clientele of a bank like SVB tended to have a lot of cash in their account. And I mean, the average depositor had something like $20 million in their account because the average depositor was a tech company worth hundreds of millions of dollars. So the FDIC insured amount for those depositors barely covered 1% of what was actually inside SVB. And as a result, there was a very real fear and risk actually that basically the entire tech startup space in Silicon Valley would disappear overnight. What ended up happening, of course, was that SVB and the other failed banks, well, they were just bailed out in full by the government, or rather I should say by the US taxpayer, well above the official insured FDIC limit. In fact, there was no limit. If a company had $100 million in SVB when it collapsed, the taxpayer reimbursed them in full. And then JP Morgan actually worked out a special deal with the government to take control of these little regional banks that fell apart as well and to turn them into subsidiaries. So in a way, JP Morgan contributed to the bailout as well. Okay, you might be saying, so why did I bother going over all of that? What's the relevance to these two banks now, Zion and Western Alliance, having a lot of people feeling shaky right now compared to what the SVB banking crisis was? Well, what the SVB banking crisis proved was that no matter what, the US government would bail out any bank in the United States because the risk of contagion is too great. And as a result of that, there is simply no reason for any bank in the United States to be sensible or risk averse with their money. If they make a risky bet, it either pays out and they make loads and loads of money, or it doesn't pay out, the bank collapses, then the government bails them out or JP Morgan bails them out. The bankers haven't lost anything, and even if they were malicious in their intent with this, they aren't going to face any legal repercussions either. The very, very essential function of risk and reward in the United States financial system basically hasn't existed since this banking crisis in 2023 proved that actually they will be taken care of and they will be bailed out and protected at the expense of the US taxpayer no matter what. And ultimately, that's why these two banks, Zion and Western Alliance, took these incredibly risky positions. They lent money to people who they didn't know, who were out there actively committing fraud, and they didn't check up on them whilst they were committing that fraud, so they only found out about the fraud 8 years after it happened. That is categorically a bad business decision run by people who frankly should be in no business running a bank, and yet they did it anyway. And really, we even see the exact same thing happen with JP Morgan as well. Their subsidiaries took on incredibly risky positions on First Brands Group and Tricolor Holdings. Why did they do that? Because they knew that there were two layers of defense in case everything went wrong, which of course they did go wrong. First of all, the FDIC insurance will always be extended to protect these bankers, and then even on top of that, JP Morgan would be willing to jump in to increase their market share of the American banking industry and to bail out any smaller regional banks as well. Now, the real big problem here is that actually this is the exact same circumstances that led to a total and complete global financial crisis in 2008. Bankers got greedy and they didn't care about making losses because worst comes to worst, the taxpayer would simply bail them out. So what did they start doing? Well, they started buying up useless, worthless, junk mortgage-backed securities that would supposedly be safe and collateralized, but in reality were all based on fraud. Now, funnily enough, after the global financial crisis, that was obviously a big problem, and everyone realized that it was the failure of the authorities to regulate these banks effectively and to show them that actually they wouldn't always be bailed out that allowed them to do this. So there was a lot of progress made in changing that in the wake of 2008 to turn that back. They did work pretty hard to return financial responsibility to the bankers, but frankly, after 15 years of basically printing money, of running massive budget deficits just to stimulate the economy, of quantitative easing into the trillions and 0% low interest rates for years on end, that goes a long way in creating a systemic problem in the way these bankers think. And then you add in on top of that the multiple bank bailouts where poor risk management is actually not only protected but rewarded. And it's no surprise that the risk tolerances of these regional banks all over the US has skyrocketed. Now, if this is so bad, then why hasn't this been a major problem, or at least a bigger problem according to the markets as you might expect listening to this video? Why did some of those banking stocks actually recover within 12 hours or so after their initial falls on this news? And why does the S&P 500's chart over the last day or two look like this, completely inconsequential, like this had never happened? Well, a couple of reasons. First of all, the financialization of the market has not extended really to the financialization of the stock markets. Yes, there are literally trillions of dollars of ticking time bombs in these so-called asset-backed securities or MBSs or mortgage-backed securities or collateralized debt obligations, whatever you want to call them, that are hanging over the economy. But the S&P 500 is still ridiculously dominated just by AI hype at the moment. So yes, banking stocks falling isn't really going to impact headliner indexes in the United States like that. But the other reason this hasn't turned out to be a massive problem is because the market has realized that this reality of bailouts for failed banks is real as well, right? The instant reaction to Zion Bank losing $50 million is, oh God, I'm going to sell my shares in case there's a run and they go bankrupt. And that caused their market price to fall by about 13%, but then it rose by another 5% before the end of the first day. Why did that happen? Well, because then the reaction from the market switched a couple of hours later as people realized what's likely going to happen. They went, hang on, the government's just going to reimburse me of any of my losses, no matter how large they are, and even if they're a result of mismanagement or maybe even fraud by the bank or those running it. So really, I should buy back in while the stock is cheaper. The truth is that the regional banking crisis from 2023 never really stopped. The fundamental problems of these banks being under-collateralized and overexposed to treasuries and other complicated debt instruments, that never actually changed. These banks are still holding literally trillions of dollars of unrealized losses on their books, hoping that they make it to the end of their maturity dates so they don't have to realize those losses. That's what caused the chaos in 2023 when some of these banks weren't able to hold on to these unrealized losses and they had to turn them into realized ones. And that's also basically what's causing the chaos right now in 2025. These banks, Zion Bancorp and Western Alliance, they already had these unrealized losses on their books. That was the financial reality of their businesses since 2016 or 2017 when they initially made these loans. That's when the real losses took place. But they've only just had to accept that and to announce to the market that they exist. Just like when SVB had to announce that they lost $1.8 billion after being forced to sell some assets to cash up. Now, the difficult thing to know here is basically what the hell we should do, right? Because these banking crises will keep happening until the fundamental weakness of these banks is fixed, but there's no motivation for them to fix themselves because of the willingness of the bank to just bail them out when they fail. So we're going to slowly accelerate into a market where bank runs just become really, really commonplace. Now, the cost of sweeping these problems under the rug will continue to grow, and the eventual crash that comes from this will be worse than if we just let everything fall apart now, with bailouts slowly being chucked on top of a taxpayer pile of debt, until eventually, yes, it will all become too much, and even the government with their promises of bailouts, no matter how ridiculous the situation still will be, even that won't be enough to return confidence to the markets. But one thing I do think is quite important to note is how badly affected European and Asian banking stocks were from this crisis in US regional banks this week. This, again, on the surface doesn't really make any sense until you realize that the US's willingness to bail out irresponsible or even fraudulent bankers does not extend beyond US shores. Barclays, one of the biggest banks here in the UK, saw their share price fall by about 6% over the course of the first 12 hours of this crisis, far more than most American banking stocks, and also far more than any American banking stocks of Barclays' size. We're mostly comparing them to regional banks, but they are a large bank, and that's because Barclays has to hope for a bailout from the UK, from the British government. Chinese banks, they have to hope for a bailout from the Communist Party of China. Deutsche Bank has to hope for a bailout from Germany or the EU, and so on and so forth. And we haven't yet seen the same evidence that other governments outside, ignoring the United States, will be willing to just unilaterally extend their equivalent of FDIC insurance. In short, a European bailout or an Asian bailout is a possibility, whereas a US bailout is a certainty. Now, just because you might not be in the US or use one of these regional banks doesn't mean that you're safe from this banking crisis. And I think it's so important that we're able to recognize that and to protect ourselves against what's coming, because it is going to be bad. So to prepare for those problems, make sure to come to my free class that I spoke about briefly earlier. I'm going to be teaching you how to build a $3,000 a month online side hustle from scratch today. It's 100% free. I've spent the last month putting this class together with my team, spending literally dozens of hours upon it. And in it, I'll show absolutely everyone how they can use this new system that my team and I have built to build an online income up to $3,000 a month guaranteed. We are limited to just 100 spaces available for the free class, only 100, and the last time we ran one of these, those spaces filled out on the first day we announced it. So click the link down below in the description to save your space and to see what time the free class is actually happening on your time zone. Again, it's free and I'll show you everything you need to build an online passive income, and we'll have some fun as we do it as well. The link is down below in the description where you can register and save your spot for the free class now.